Hi there folks. Now, as you know, when we analyse the financial markets, there's basically two ways we do it. We can use the technical analysis, which is basically the look back at price and previous price action in the form of a chart. We look for patterns and indicators to help us predict where prices may go in the future. That's technical analysis. But today I want to home in on the fundamental analysis. Now, the fundamental analysis is like the macro view. The macro view of, say, a particular stock or a sector, or in the case of the Forex market, we look at the macro view of the state of a particular economy. And the way that we do that is we look at a series of economic releases that are periodically put out throughout the calendar month. And this gives us clues to the state of the economy and therefore gives us clues to where the currency should go. So today I want to home in on the main ones that you should be aware of, the main drivers behind the currency markets. And we'll also talk about where you can get this information as well. So come on, let's get to it. So the fundamental analysis is a macro view of the economy standing of a particular country. So the theory is that if an economy, if a country is doing really well, then the currency should do really well as well. If the economy, if the macro picture is looking really bad, there's mass unemployment and so forth, then that is reflected in the currency value as well. And as currency traders, as Forex traders, we're always looking to buy a strong currency and sell a weak currency. We're looking to benefit from the discrepancies in the two different currency values. And that's basically what we're doing with fundamental analysis. Let's just briefly talk about now how an economy is set up. Now, the central bank is basically, every developed nation has them. Central bank basically is there to control the economy's growth. And most central banks around the world have two mandates set upon them by their local government or by their government. And the typical mandates that they have are to control inflation and full employment. So that's like a dual mandate. Some just have inflation, some just have employment. But most central banks have this mandate. They have this objective to control inflation and keep people in the workplace. Now, inflation, normally developed world, I think we're looking around the 2% level at the moment. So anything above 2%, they've got to act. Anything below 2%, they've got to act. They want to keep inflation around the 2% level, which is deemed to be a healthy growth for a particular economy. And the way that the central banks control inflation and employment is by using monetary policy. So the central bank is able to affect the economy by using monetary policy. Two parts of monetary policy. You've got interest rates and quantitative easing. Interest rates basically determining how much it costs to borrow money from the bank, how much money you will get if you deposit money. That's basically the interest rates. They control the central bank interest rate. They put that onto the local banks, who then put it onto the general public. It affects everything from credit card loans to car loans and so forth. All comes from the central bank's interest rate policy. And you've got what's known as more recently as quantitative easing. Quantitative easing, basically because interest rates have got so low in the developed world these days that they can't go any further. Well, they can go negative, but what they're using these days is quantitative easing. That's basically putting money back into the economy by buying back their government bonds. And when they buy back government bonds, they're putting money back into the system. It's in theory basically an interest rate reduction by flooding the markets with extra cash. So the central bank controls inflation and employment by using the power of interest rates and quantitative easing. This is basically what we call monetary policy. Now, the theory is, as interest rates rise, so should the currency. So currencies will get stronger as interest rates are rising. Well, clearly, because if you want to take advantage of a high interest rate environment, you need to buy that particular currency to be able to invest in that particular economy to get those higher interest rates. So if you're buying a particular currency, clearly the currency should go up in value. So it's generally the norm that rising interest rates leads to a strengthening of a currency, and conversely, falling interest rates tends to see a weakening of a particular country's currency. That's basically what it's all about. So that's basically how the central bank control with monetary policy, employment and inflation. So how does the central bank know what to do with interest rates? Well, the central bank does what you and I do. It looks at the news, it looks at the economy, it looks at the economic releases that are released throughout the calendar week and month. And that's exactly what we do as traders. And that's why, as traders, it's important that we understand what these news events mean and how they affect the market. Now, the biggest news event of the calendar month is unemployment. Now, in the US, this is called non-farm payroll. Unemployment, everything stems from employment. Clearly, if people are in work, people are earning money. If people are earning money, what are they doing? They're spending money. And if people are spending money, what is the tendency to happen to prices? Prices go up. Remember, prices are inflation. The government then, the central bank then, sees prices going up, inflation going up. They may have to react by moving interest rates up. They will move interest rates up to stop people borrowing more money and encourage people that have money to save money as opposed to spend money on goods and services. Remember, if you're buying goods and services, they're spending money, prices are likely to go up. So they will increase interest rates to encourage savers to save and borrowers to borrow less. So unemployment, everything really stems from unemployment in all developed nations. And as I say, in the US, it's called non-farm payroll. It's basically unemployment outside of the agricultural sector. It's normally on the first Friday of every month. And as you may know by now, we do stream it live as well. We also give lots of dollar cash giveaways as well on that event. So unemployment, a key event on the calendar month. We're just going to go through a few other events now. So I'll show you basically their impact and how the central bank will look at them and how we should look at them as well. Certainly, whether you're trading fundamentals or not, you should certainly know what is driving the markets. Average earnings. Well, clearly this is, again, it's another monthly data. Shows you how much people are earning compared to how much they were earning last month. If people are earning more than they were earning last month, well, what does that mean? It means they've got more money in their pockets. More money in their pockets, what are they doing? They're spending more money. If they're spending more money, what's happening to prices? Well, prices are going to go up. Inflation. Oh, central banks have to act on inflation. If prices are going up and everyone's earning more money, we better start moving interest rates higher. That will encourage those people that are earning to save their money rather than to spend it, deflating the prices. If people are wanting to borrow money, of course, that also pushes up. But if your average earnings are pushing up, then you have the tendency to spend more money. So governments, central banks are always looking at the average earnings as well. Then you've got retail sales. Well, that's basically it. That's basically showing you what people are doing on the high street. Are they buying more? Are they buying more goods and services? Is everyone out there actively spending their money? But you can see the inflationary impact there immediately. If retail sales are going up, everyone's buying lots of goods and services, it's likely to have an effect on inflation. Central bankers may have to act. Durable goods. Durable goods is a good one. What are durable goods? Well, durable goods are products that you don't buy every week, like food and so forth. Durable goods could be your washing machines or your tumble dryers or a new fridge freezer or something like that. Goods that's durable. You normally keep them for 5-10 years or so. Clearly, if you're looking to buy a new tumble dryer or washing machine, well, you only do that if you're optimistic about the economy. You're optimistic about your job. You're not going to start buying all these great goods and service goods, long-term goods. If you're worried about your job, you're not going to be buying all these if you haven't got a job. If you're worried about losing your job. So the durable goods shows you what people are spending on the bigger ticket items. And obviously this is a vote of confidence, and governments are looking at, central banks are looking at that as well. So durable goods basically comes out once a month. How much durable goods increased or decreased from the previous month. Good early indicators. Another early indicator, it's called the Purchasing Managers Index. Now this is, I think, the most important economic release alongside the unemployment that comes out every month. It's basically a forward-looking indicator. So when I say a forward-looking indicator, retail sales, durable goods, average earnings, that's looking at last month's data. Looking what happened the month prior, comparing it to the year prior. And that's basically a lagging indicator. The Purchasing Managers Index is a forward-looking indicator. So basically it's a survey and it goes out to all the business leaders in construction, manufacturing, services, asking them what their outlook is going forward. Anything above 50 is deemed to be expansionary, so the economy is expanding. Anything below 50 is an economy that's deemed to be contracting. So basically, if the PMI, the purchase managers, comes above 50, it means employers are looking maybe to invest in more plant, invest in more personnel, employ more people, staff and so forth. Again, that is inflationary. That's maybe having an effect on the employment figures. So it's a forward-looking indicator. So central bankers like to get a heads up on the economy by looking at the PMI data, which is coming out in all the economies throughout the calendar month. A very, very important piece of data. Housing data, clearly that is a big ticket item. There's various forms of housing data that comes out. I didn't list them all here, just listed a few. You got new home sales, housing starts, mortgage approvals. Well, clearly, you're only buying more housing, you're only investing in a big ticket item like housing if you're optimistic about the future. So it's a good sort of view of where the economy is going. If obviously lots of people are buying houses and taking on mortgages, it means that the economy is bubbling along quite nicely and there's a lot of optimism there. Optimism leads to higher prices. Oh, that's inflation. So the central bankers may have to move interest rates higher. Interest rates higher, maybe the currency should follow. That's the theory anyway. Producer Price Index, PPI, comes out once a month. Basically what producers are having to pay for their goods, for their raw materials. So of course, if raw material prices are going up, their producer prices are going up, they have to pay more for their oil and pay more for their commodities and their raw materials. They're going to have to put that cost through onto their customer, onto the retail. That's you and I. And that will go through in terms of higher prices, inflation. You get in the picture. Potentially interest rates will go up, potentially the currency will go up as well. Then you've got the GDP. GDP is basically the health of an economy. It's the gross domestic product, basically how much money the government has. Is the government expanding or is it contracting? Like your bank balance. If your bank balance is growing, then of course you're getting more wealthy. The GDP is basically the current wealth of the country. Is it expanding or is it contracting? It's basically like everyone else. And then you've got the consumer price index. That is the inflation. That is the sort of the raw figure that they look at in terms of what is happening to prices. It's basically a basket of currencies. The analysts get together. No one really knows the actual formula, but it basically tells us what inflation is doing. Remember, most central bankers have a mandate to keep inflation above or about 2% as well. So that's basically the macro news. There's lots more coming out as well throughout the calendar month. We're watching it all the time in the trading room. Of course, we're discussing the implications as we go, but they're the basic ones and you get the idea, the premise behind it all in terms of central bank and what they do. Another bit of macro news that comes out once a month is the interest rate decision. So all these central banks around the world, they get together every month and they decide what they're going to do with their interest rates by looking at all that economic data that I have just spoken about, and they make their decisions. As I say, all the major developed worlds have them. So here you've got the USA. You get to know these acronyms. US dollar, that's the Federal Open Market Committee, often known as the FOMC. They get together and they discuss it over 2 days, and then a big decision comes out. Are they moving interest rates? Are they not moving interest rates? And it's followed on with a statement as well, telling you why they made their decision to act or not to react. It gives you a statement generally looking at their economic forecasts going forward as well. In the UK, it's called the Monetary Policy Committee. That's the MPC. The euro is affected by the ECB. That's the European Central Bank. You've got the JPY. That's the Japanese yen. That's basically the BOJ. The RBA, which is the Reserve Bank of Australia. And the Canadian dollar is affected by the BOC in New Zealand, the NZD, that's the Reserve Bank of New Zealand, the RBNZ. So you get to know these acronyms. When we say, oh, there's the BOC later, you know exactly what we're talking about. The BOC, basically the Bank of Canada is going to decide on interest rates, so we're watching the Canadian dollar. So those are the interest rate decisions, so be aware of those. We definitely need to be aware of those as Forex traders. And central bank speakers. Central bankers, they like the sound of their own voice. They're always on the news wires, always being interviewed, always getting their views out there, letting the economies and letting the traders and the investment world know what their line of thinking is. It's all part of the forward guidance policy that many have taken on these days. They don't want to shock the markets. So the markets are always waiting for their decisions, but because they're on the news wires throughout the calendar month, hopefully no shocks are going to cause any big massive problems in the market. So the central bankers are out there, so we do need to be aware. You'll often hear us talking about Lagarde speaking, or we might be talking about the Fed chair, Powell speaking, or what have you. So whenever they're speaking, the markets normally sit back and look. Certainly if you're about to take on a trading position and a big central bank speakers to come out and about to talk about economic policy, maybe you want to hold fire before you make that trade. So certainly be aware of that. Now we do, so where do you get all this information? Where do you find out all this information about these economic releases? Well, you go to an economic calendar. We do have an economic calendar where you can get all this information, and I will show you that now. Okay, so what you need to do is go over to the forexsignals.com website. Nice pretty picture of me there. Scroll right down to the bottom and you'll see a menu here of all our free content. You can see the currency heat map, a currency profit calculator and so forth. Click on the Forex economic calendar and it pulls up this economic calendar, giving you an insight to what we can expect for the week ahead. Now you can select to just look at today, or you can look at the next 7 days as well, and you'll scroll through there with all the different data releases. Now the best way to read these is to look at the impact column here on the right. Now if it's a red impact, that basically means it's likely to have a high impact on the particular currency. Now this would be Governor Lowe talking in Australia. His speech later, it's in red. It's basically one to pay attention to. Click on the little bell there. It's going to send a notification to your calendar, so you'll be notified by your calendar when the event is about to happen as well. Here you'll see it gives you the previous read, what basically was announced last month, and it will also show you what they're expecting for this month as well. And the way we look at these economic releases normally is if it's bang out of line, it's a massive deviation from what the analysts were expecting, then it's likely to have an impact on the market. It tells you the date of the release, how many days to go as well. So really cool piece of information that you've got at your fingertips, absolutely free of charge if you come over to the forexsignals.com website. Here's a really cool feature. If you're unclear of what the economic release is actually all about, what it actually means, just click on it and up will come a description and the likely impact it could have on the markets as well. So it basically gives you a description of what that economic release is. A really cool feature as well. A lot of our members absolutely love that. I know that for one thing, because they don't ask me so many questions these days as well. So that's the economic calendar. It's free for all that want to explore these economic releases. Okay, so I hope you found that useful. Hopefully now you've got a bit of a better understanding of the main drivers behind the financial markets. Now give me a thumbs up if you liked the video, give me a thumbs down if you didn't. Don't forget to leave a comment. I love to hear what my followers are saying, any views, anything you want me to cover in the subsequent videos, please do let me know. Now don't forget to follow us on all the socials as well. If you follow us on Facebook, of course you can tune in live every 2 p.m. London time on a Monday, where we discuss trading opportunities for the week ahead. Now you may also have noticed that I release a video every Monday as well, basically discussing some of these economic releases, looking at the macro view, looking at trading opportunities for the following week. So it really is a good way to start your week. If you want to make sure you don't miss that, subscribe of course and hit that bell notification. You'll get notified the moment that video has been released. Now, as you may or not know, we do stream live up to 6 to 7 times a day around the clock. So if you want to take part in that, you can absolutely free of charge. Come in for 7 days, check it all out just by subscribing below here. It's free trial for 7 days. If you don't like it, you don't have to stay. I think you've got everything to gain and nothing to lose. If that's not for you, not a problem. I'll see you next week, same time, same place. Have a good week.